Okay, now let's go to the sectors in DGRO. At first glance, we can see that 10 out of the official 11 sectors are represented. This is because, if you remember, real estate investment trusts are not allowed into the index. We can also see that the double-digit percentages go to the financials, healthcare, tech, industrials, and consumer defensive. This is an interesting mix. We have 3 cyclical sectors and 2 defensive. The cyclical sectors, which in the top 5 are the financials, technology, and industrials, mean that when the economy goes south, the profits of the companies in it go down a lot more than the ones in the defensive sectors. It is arguable whether technology is one of these sectors if we include companies like Microsoft and Apple, without which we can't function as a modern society, but this is a topic for another video. First, financials. These are companies that provide financial services like banks, payment processing, asset management, insurance, etc. I have shared how I feel about financials in other videos, but to sum up quickly, I don't feel comfortable with investing a lot in that sector because, in my opinion, it is very easily disrupted by technology and government regulation. As a quick example, central bank digital currencies can kill the business model of banks and card companies like Visa, MasterCard, or American Express. Blockchain can kill the model of brokerages or asset managers that provide custodian services because it allows everyone to be in full control of their assets that have the title of the owner in the blockchain, which is only accessible through his or her private keys. I don't want to get carried away here, but these are one of the reasons I have almost no individual financial stocks in my portfolio currently. When they are part of an ETF, the risk is mitigated because if one fails, it won't be as catastrophic. But if, for example, some of the above technologies get adopted en masse, this will really hurt the ETF. The second sector is healthcare. This is generally a great sector to have as a top one in a dividend ETF, in my opinion, because it gives the ETF safe and steady cash flows that are not dependent upon economic crisis or booms. Anyone who is sick already is taking a pill regardless of whether we are in a recession or not. The tech sector comes third. This is totally fine with me because, as we know, this sector is the biggest engine of growth for our society. Unfortunately, it is not famous for its generous dividends because the companies need to reinvest a lot in new technology to stay competitive, but this sector being 16 to 17% of the ETF means that while you are focused on dividends, you will also participate in any tech-related market rally, which I find reassuring. The fourth sector is industrials, which are companies that are in the construction, transportation, machinery, etc. businesses. These sectors' profits go up and down with the economic cycles, so it is more vulnerable to economic downturns. Famous companies include UPS, 3M, Boeing, Caterpillar, etc. I'm generally bullish on the industrial sector of the USA as long as onshoring keeps being a policy in the country and the relationship with China is deteriorating. If you believe the USA needs to build out a powerful industrial base that is not dependent on China, then this is the sector where a lot of the profits of that process will go to. The fifth sector with 10.5% is consumer defensive, also known as consumer staples. This is the sector that produces food, beverages, cleaning supplies, tobacco, different kinds of household items, etc. Naturally, it is very immune to market and economic downturns and provides a stable and steady stream of dividends. Actually, one of the most iconic dividend pairs are part of the sector: Procter & Gamble, PepsiCo, Coca-Cola, Altria, and others. I generally like to see this sector having a bigger part of an ETF. 10.5% is not that high, but combined with the 19% in healthcare, this gives us almost 30% of very defensive cash flow coming from DGRO. Sector 5th to 10th have considerably lower percentages of the ETF invested there. We have utilities, energy, and consumer cyclical at 6%, and basic materials and communication at the negligible 2 and 1% respectively. Just a quick explanation. The utilities sector is full of companies delivering us the electricity, water, and gas we all need to live our normal lives. So their cash flow is very defensive and immune to economic downturns, but they are very heavily regulated. The energy sector has companies like Exxon, Chevron, Shell, Enterprise Product Partners, Enbridge, and others that pump oil and gas from the ground and then store and transport it. More recently, there are also newcomers to the sector from the green energy side. Basically, this is the sector which makes our society not being stuck in the Middle Ages. Also, the companies there are famous for their generous dividend and share repurchase programs towards their shareholders. So I would like to see that sector as a bit bigger part of the ETF. The consumer cyclical sector is the sector that has stuff like luxury items, cars, travel, etc. in it. It is very vulnerable to recessions and rising unemployment because in times like these, people cut stuff they don't need first. However, it is home to one of the biggest and most innovative companies of our times, like Tesla and Amazon. The basic material sector is comprised of companies that dig and process the materials we use to build our buildings, machines, and basically everything. We're talking iron, copper, nickel, silver, etc., etc. This is a very important sector for our society. However, the profit of the companies in it varies greatly in tune with the prices of the commodities they sell. That means that the sector is famous for its big dividend yields that can easily get slashed by 30% for reasons completely out of the company's control. However, if we're going to continue with the green energy transition, there is a lot, and I mean a lot of stuff like nickel, lithium, iron, cobalt, silver, etc. that needs to be mined. So probably the quality companies of the sector will be able to capture that upside. And the last sector, with only 1.5% is communication, which is made up of companies that help us communicate. And that's it. If you're getting value out of this video, click the like button and also subscribe to the channel by clicking the subscribe button and the notification bell. That way, you'll be directly notified when I release new videos instead of relying on the algorithm to show them to you. The amount of engagement I get shows me what types of videos the audience enjoys. So I thank you so much for taking that 1 second to do that. It means the world to me. This is just a small part of my complete guide I did on the DGRO ETF. To check the full review, go to the video that should have appeared on your screen right now or to the description below.